Welcome back to the Gold News Channel. My name is Kerry Stevenson, and today I am speaking with Keith Weiner. Now, some of you will know Keith from back in, Keith told me it's the before times in 2019 when he presented at a gold conference back in the day when you could meet face to face. We will do that again, ladies and gentlemen, but I wanted to bring him on today. He's the president and founder of the Gold Standard Institute of USA. He's also the CEO of Monetary Metals. We're going to talk a little bit about monetary metals. We're going to talk about what is money. Now, I recently posted on social media an article that Keith wrote all about money. You know, what is money? Most people don't think about money. They kind of think about it, but they don't really think about what it is, what it's there for, and its purchasing power. It's just they've got some, they spend some, they save some. Keith, welcome to the Gold News Channel. Great to see you, and happy Thanksgiving.
Happy Thanksgiving. Thanks for having me on the channel.
Keith, first up, that article you wrote, What is Money? Just explain to those of our listeners out there, mainly who enjoy gold, are interested in gold, but I'd like to hear your view. What is money?
Well, it's an interesting question. I think the first thing I want to say about it is that in the world today, we're just presented with lots of examples where there are two concepts that are kind of similar but fundamentally different. They get lumped into the same word. And so I remember in science class in junior high school talking about accuracy versus precision, and those are often confused as being the same thing, but they're actually quite not. And in the case of money, there's a very similar concept that is often confused with money or substituted, and that's currency.
Yeah.
People think about what is the medium of exchange, right? If I go to my local McDonald's and I want to buy a hamburger and a soft drink, I hand over some sort of piece of plasticized paper and call that money. But is it? And is there a difference between currency and money? So I'm a student of the Austrian School, founded by somebody named Carl Menger, arguably in the 1870s. With the publication of his book, Principles of Economics. And he talks about, the evolution. Think about, ancient Homo sapiens. So Homo sapiens have been on this planet for something like 250,000 years. Most of that time, there was no history, there was no writing, and, people were living not much different from animals, like a troop of monkeys or gorillas. And then somewhere in the ancient world, perhaps 6,000 years ago or 7,000 years ago or something, there started to be enough accumulation of knowledge, right? So knowledge accumulating very slowly in the time when the only way to learn from someone else was whatever might randomly be shared as a story over the campfire at night. Knowledge did not grow very rapidly, but they accumulate enough knowledge, they begin to be able to produce tools with enough productivity increase that for the first time they're producing a surplus. So you can't really have trade if you're just producing subsistence. You go down to the river and you spend all day with your hands on the water trying to catch a fish. And every once in a while you catch one and you're living on the ragged edge of starvation, but there's no surplus. And therefore there's nothing to trade, and all the problems of trade and therefore of economics don't really begin to occur. But at some point they're producing enough to have a surplus. And then two things happen. One is they want to trade with each other. And then two is you get specialization. Somebody turns out to be better at getting fish out of the river. Somebody else is better at getting deer out of the woods. Somebody is better at turning the deer hide into moccasins to wear on your feet. With feet, with shoes on your feet, now you can run faster and you're more robust to walking on rocky, shores and getting into the river. So that's just increasing productivity even more. So I wrote an article on Forbes where I talk about this, and I say, so picture somebody who produces leather moccasins is hungry one day for dinner. So he goes to the fisherman, and says, I'd like to trade you a pair of these fine leather moccasins for some fish. So he gets 6 fish. The next day he comes back and he's hungry again. So he wants to get more fish, but the fisherman says, I have these new leather moccasins. I probably won't need another new set of shoes for another 6 months. So obviously the moccasin guy has a very big problem because he's hungry, but the whole society has a big problem. And that problem is called the coincidence of wants. You can't trade unless the other person has what you want, but also you have what he wants. See, otherwise no trade is possible.
Mhm.
So what people begin to discover is, hey, I could trade my leather moccasins to somebody who might have something like, let's say, dried fish, some sort of dried fish monger in the village. And then I can always trade the dried fish later for something else. Then they discover that salt works better than dried fish. And ultimately they discover gold works better than anything else. And so when I say work, what I'm talking about is when you try to trade into that good, you're getting a certain price. And then when you need to get rid of that good to buy what you really want, you're getting a different price. And there's a spread between the two. And that spread is the measure of your loss to trade in and out of that good. And so what we're really talking about here is the economics concept of marketability. And every good has a different marketability, which is kind of in the nature of that good. And if you rank all of the goods in descending order of marketability, you see what's at the top is the most marketable good. And that most marketable good is gold by far. And silver, is the only thing that comes remotely close.
Why do you say that? Why do you say that, Keith? Why is gold the most marketable and silver comes second? Because, maybe I don't like gold or silver and I want to, I prefer, for example, another instrument for me in modern times might be Bitcoin, or it might be wing wang crypto doodah, or it might be something else in its entirety, some sort of derivative of a derivative, because there's so many different financial instruments these days. Because of that, doesn't it make the potential for gold being the ultimate store of wealth, money, whatever you want to call it, irrelevant?
Well, I'm not even talking about store of anything yet. I'm just talking about the loss to get in and out, which is basically as a medium of exchange. But in the ancient world, of course, they don't have derivatives and they don't have computers, no Bitcoin. So in the ancient world, it had to be a physical good because that was the only kind of good they really had.
Okay.
Today, I think physical good is a very important distinction. We're physical living beings in a physical world. And there are times when nothing less than delivery of a physical thing is going to work. Anything that isn't a physical thing is at some point a credit or some sort of entry on somebody else's ledger. And there are times when that's no good for whatever reason. Now, maybe not most people most of the time. And in normal times, a lot of people are perfectly happy to take a flyer on the system. But in extremis, nothing less than taking physical delivery of something and saying, I have it, and now it's mine, will work. And so it has to be a physical commodity. And so in terms of medium of exchange, the dollar works really well. I mean, the spread is basically zero on the dollar, but the dollar is somebody's credit. And so what I'm doing now is I'm making a distinction. So money is the physical good of greatest marketability, or the physical good with the least spread. Credit is ultimately when somebody's recording something owed to you, or somebody's recording you have this amount worth of this thing. That's a credit of some sort or another. And I've defined credit in a way that's broad enough to encompass Bitcoin. Bitcoin is a ledger. That ledger records you have this thing. Kind of an interesting proof of this is the fact that Bitcoin can fork. It has forked a number of times.
Yeah.
Now, that doesn't mean that the fork is accepted and the fork isn't called Bitcoin. The fork is called Bitcoin Cash or Bitcoin Gold, ironically, Bitcoin Gold.
Yeah.
But interestingly, those forks have some value that isn't zero. And of course, it's impossible to clone a physical good. If I have a bar of gold, there's no cloning machine or cloning technology to make a second bar. But if I have a Bitcoin, someone can clone the ledger. And if there's enough people that are into it, then that clone can have value that may not be as high as Bitcoin's, but it might still be a very significant value. So money is the most marketable good. The other definition, so that's from Karl Menger. That's the origin of the Austrian School. The other definition that I would give it, which is not necessarily accepted even in the Austrian School, is the extinguisher of debt. So if you owe somebody something, money is the thing that makes the debt go out of existence and not merely shift it. So suppose I owe you, and then I have a piece of paper that's an IOU from somebody else, Joe Smith.
Mhm.
Now, if Joe Smith is relatively well known, has a good reputation, I might be able to say, hey, Joe Smith owes me about what I owe you. Why don't I give you this piece of paper, endorse it on the back, and now it's yours. You might accept that. And maybe Joe Smith might even be a better credit risk than me. He might be a relatively well-known banker. I'm just some schmo from America. You know, you might actually prefer his paper. So I get myself out of the debt loop, but the debt is not extinguished. You are still owed, but the party who owes you is now, you know, shifted. So a currency does not extinguish a debt, it merely shifts it around. But the payment of money, if I owe you something and I hand you a gold coin or some gold coins, the debt goes out of existence. We can take the piece of paper that says I owe you something and tear it up, and you're happy because you have gold coins in your hand. Now, the way of looking at gold and why gold versus anything else. So crude oil is today, what, roughly $80 a barrel US?
Yeah.
Suppose we're talking about something like, you know, $100,000 of debt, right? So to pay that in oil would be 1,200 barrels.
Right.
And a barrel is what, 50 gallons? We're talking about basically a swimming pool full of liquid, which is sticky, toxic, volatile, flammable, smelly, and it fouls everything that it touches, and it, you know, required a lot of effort to clean. If somebody owed you that amount of value and said, okay, I've got this oil tanker truck, where would you like that delivered on your front lawn? Wait a minute. But $100,000 would be something like 2 kilos of gold. And gold is so heavy and so dense, 2 kilos would be like 2 iPhones.
Yeah.
Or probably more like an iPhone, you know, the big size iPhone would probably be about 2 kilos, maybe slightly thicker. I mean, you could put that in your pocket and walk away with it. And furthermore, if there was, let's say, a slight glut in the local market in Queensland and a slight deficit in, let's say, in Melbourne, then that gold that's in slight glut and where you are could be in Melbourne one plane trip away, assuming within the lockdown anyway.
Well, not quite at the moment, Keith, but hopefully soon.
So gold is really good at moving to from wherever there's a slight glut to wherever there's a slight deficit, always evening itself around. You think about oil, what would be the cost of taking, so, you know, 1,200 barrels is probably a small convoy of tanker trucks. What would be the cost of getting that convoy of tanker trucks, you know, that distance away? Well, that would be a very significant expense. So gold has a number of economic properties. Interestingly, people say gold has value because it's scarce. It's true to a degree. I mean, you can't just go and like find gold on the side of any, you know, random road. But actually, gold's pretty plentiful. There's a lot of it out there. There's enough that everybody can have some if they want to have some. It's not, you know, I always joke and say unobtainium, if there were such a thing, wouldn't really work as money because there isn't enough of it to really go around. So it's not gold's scarcity per se, but it's a combination of a bunch of physical and economic characteristics. Obviously, it's durable, it doesn't rust or tarnish. It can be divided into arbitrarily small amounts. I mean, one little grain of gold is the same as any other. But
and there you go, ladies and gentlemen, that's the size of a gram of gold, just in case you were wondering the size. There you go. Teeny tiny, there's my finger. Sorry, Keith, just to put it in perspective.
That's right. And it can be recombined too. So if you don't want a lot of little grains, you can make one big bar again by melting it. So it kind of money has to be a metal. This metal is the only thing that has that characteristic. You can chop it up into really small pieces and you can recombine the small pieces into one big piece, and all that substance is uniform. It's the same. You know, a diamond, as soon as you cut it, it's lost all of its interesting characteristics.
I hadn't thought about that. Yeah, okay.
It's obviously recognizable, easy to test for. You know, you don't need particularly high tech to tell if something's real gold if it's fake. Almost nothing has gold's density. Nothing else has its color. Gold is very soft. You know, the only thing that has gold's density is tungsten. Tungsten is extremely hard. So, with your teeth, you can tell if it's gold or tungsten. So it just has a variety of characteristics that just make it work really well for that purpose. And that's why gold has been money for thousands of years and will continue to be money.
Well, Keith, I wanted to, but before we run out of time, I wanted to talk about what monetary metals are doing right now, because for a long time people say, well, why would I buy gold, stick it in a vault where I have to pay storage fees year on year, and they kind of scratch their head and go, well, it doesn't give me a return. Now, what you're doing is you're turning that narrative around a little bit. So just explain to my listeners what monetary metals are doing and why you think this is significant for people.
So we're paying interest on gold, and that's the long and short of it. And we do that by leasing it to businesses that need physical inventory. We're lending it to gold miners, and we're doing it with due diligence and terms and conditions that make it, work for, suitable for investors. In a certain sense, we're doing nothing differently than what had been done for thousands of years. And in the perspective of the long centuries of history, we've only had a very small blip recently where this hasn't been done, which is post 1933 in America, and plus or minus a few years in the rest of the world, where the governments have conspired against gold and said, you're not allowed to use it for this purpose, which is financing productive enterprise. I mean, every bit of food you eat, every car you drive, every phone you buy, every phone service carrier that gives your phone a connection, all this stuff has to be financed. And to finance it, you need a form of money that's stable. Otherwise, finance doesn't work. It breaks down in various ways, which is what we're seeing. That's the problem in the world today in a nutshell. Finance is breaking down because the money is screwy.
But why is the money screwy, and why did governments conspire against gold? Well, go back to that little point. Big point.
Governments discovered, probably known it forever, but the culture had arrived at the point, I guess I would say in the late 19th century, early 20th century, where they can buy votes by spending money. Right? So if you live in a little town and they say, we're going to subsidize your town center by putting in this huge fountain and all the sculpture, and we're going to put in these arched archways with little lights on the top and just make it really pleasant, and put in all this art installations and other things. And of course, all the people that do business in that town, especially that come to the town center for commerce, are going to love it. They're going to vote for you. So the government is always looking to spend money, but in an honest monetary system, the only way the government gets money is by taxing the people. And so, although spending is popular, taxing is not. So borrowing would seem to be the magic thing that gets them outside of that constraint. If you could borrow as much as you wanted, then you can spend as much as you want, buy as many votes as you need to win re-election, and there's no price to pay. So the purpose of a central bank, in my view, is nothing more than to enable the government, and of course their cronies, to borrow more and spend more than they otherwise could at a cheaper interest rate. So they want to push the interest rate down. Gold has an interesting discipline in that, because you have a choice to either hold your gold coin and hoard it or lend it only if you like the interest rate and the risk. There's a discipline there, because the person who owns the money has the choice whether or not he wants to lend to you. So if the government is sinking deeper and deeper into debt, and the only thing it's promising is more spending, but not only more spending on things that aren't going to produce a return, not on capital improvement, but on doling out welfare of all the various flavors and forms, whether it's subsidies for electric cars or whether it's food stamps or whatever you call them in other countries, then people are not going to want to lend to the government, and so the government's credit dries up, the interest rate goes much higher, and so then they institute central banks to make it basically be enablers. And so gold gets in the way. So you have a central bank with gold. In the United States, that's from 1913 to 1933, so a 20-year period. You got a central bank and gold. And that's kind of a contradiction. And gold is working to constrain the central bank and the government in ways that they found politically unpalatable. So in 1933, they said, okay, we'll just sever the tie, at least for domestic American citizens, we'll just sever the tie entirely and force everybody to deal with our credit, which is now irredeemable, in lieu of money. If you need a money balance, well, now you have to hold government credit, which is very convenient for the government, but it disenfranchises the saver. Now you don't have a choice anymore. To hold the money balance is to be a creditor to the government, or you can be a creditor to the central bank, or you can be a creditor to the commercial bank, but all three in cahoots, all three are financing each other. And so you have no real way to opt out anymore. And so when they want to take you along for a ride, drive the interest rates to zero or negative interest rates or do whatever they want, all of which is happening around us in the world today. So Australia is in the favorable position of still having a positive interest rate. America still has a positive, just barely. America has a positive interest rate, just barely. But in the UK and Scandinavia, Switzerland, Japan, they have negative nominal rates, below zero, right? So you buy a bond for 1,000 whatever pound, Swiss francs, and you get back 990, in 5 years or something like that.
Doesn't make sense. Doesn't make sense.
It's screwy in so many ways. Obviously, one, it's literally screwing the saver to invest in that. But now think about, suppose you are the CEO of a little enterprise that's actually destroying your capital at the rate of -1% per year. In any normal business, any normal economy, in any normal world, you should be out of business.
Yep.
The sooner the better. Whatever capital you have left should be going over to some other more productive use because you are a destructive use of it. But suppose you could borrow at -2%. You're only destroying at -1%. You actually have a net +1% profit. You're actually being paid a profit to destroy capital. So the perversity of this system, the deeper you drill, the more perversity there is. And when you have a perverse incentive, you get perverse behaviors. Perverse behaviors create perverse outcomes. So when I say the world is screwy, what I really mean is we have perverse incentives that are creating perverse outcomes. And so negative interest rates are very serious. They should be treated like a monetary cancer.
Yeah.
A very serious thing. You don't just let it go. As with cancer, you don't just let it go. You do something.
But it's like a drug for the governments. They love to spend. They don't want that accountability. And as you said before, what are they going to do? They want to be voted back in, so they want to dole out what I call the funny money to anybody and everybody. So what's to stop this continuing ad infinitum?
So there are certain business models, and I think ours, monetary metals, is one of them, that kind of do an end run around the government. So if you look at Uber, Uber did not try to lobby the various taxi commissions in all the different cities to say, your taxi cartel is monopoly, ridiculous. It's 1930s, national industrial policy type, agency. This doesn't make any sense. You should have a better taxi law. They just said, no. Everybody has a smartphone. Everybody has Google Maps or the equivalent. Let's just give people the ability to call a ride, and then they can see where the car is. They can see when it shows up, so they can stay where it's warm and comfortable and finish their drinks with their friends and only walk out the front door when their, the car is actually waiting, right there. And so they gave people a power that previously the people never had. And obviously the taxi cartel prevented. And so they changed the model. And what we're doing is we're giving people the power to decide to invest their gold only if they like the risks and the interest rate, or not if they don't, which is exactly what was taken away by legal tender laws and central banks and irredeemable currencies, going back to the 1930s. And people have that choice. And there's one other thing that's worth saying about the dollar, and that is why it has so much value. I mean, by every conventional theory, the dollar should have collapsed. I mean, they printed so much of it. The credit is so ridiculous, what they're borrowing for. It should have collapsed long since. But yet the dollar is as strong as ever, if not stronger.
Mm-hmm.
Why is that? And the answer is two things. One, with every tick down in the interest rate, there's a greater incentive than ever before to borrow more. And this hits every consumer with all the ads to take out credit cards. And even in the midst of all the global supply chain problems and problems manufacturing cars, there's still ads in the US all the time for 0% for 72 months.
Wow.
0%.
So they're encouraging people to get into debt more and more.
That's right. And with every downtick, the encouragement increases.
Yeah.
So if you had the strength, the backbone to resist yesterday's offer, now they lower the interest rate and make it even more tempting. I just got a brand new phone. I know it's my old one, but I just got a brand new phone, and then they gave me 0% for 24 months. I'm like, well, it's free money. I'll take it. Why not? So that's number one. Number two is the greater your debt load, the stronger your bid on the dollar, for two reasons. One, if you don't have any debt, you don't need a big buffer of cash, sitting around. So suppose you own a business free and clear, and you have $20,000 in cash in the bank. That might be fine. What could happen? I mean, even if they close your business or whatever, you have some cash, and everything's fine. You can put that cash to work in something else. But let's say you had $1 million debt load. You can't just have $10,000 or $20,000 in cash if you're carrying $1 million worth of debt. You have to have a much bigger cash balance. So the greater the debt, the greater the demand for cash just simply as a reserve. That's number one. But number two, every productive business needs to be financed. That's rule number one. I mean, anything bigger than a mom and pop workshop needs financing. All the food you eat, all the cars you buy is financed by borrowing. Number two, once you take that debt, you must produce as much as you have to and dump that product onto the market to fetch whatever bid price that it will fetch, to raise enough money that after your expenses, your net is sufficient to service the debt.
Just to service the debt, not to pay back, just to service.
You have to pay the interest, and if you fail to pay the interest, they will repossess everything you have. So everybody's going deeper and deeper into debt, which means they have to work harder and harder and harder to dump all of their goods and services and sell it for dollars. So if you define the value of the dollar as the purchasing power of what it can buy, there are more and more companies that are getting into more and more debt, that are producing more and more stuff to dump, to raise dollars desperately to service their debt. So the deeper the debt problem goes, essentially, the more people that are dumping the goods that provide the purchasing power for the dollar. So it's all very perverse. None of the things that I've just said should be treated as a defense of the dollar and say the system is great, it's working fine. It's more a description of the pathology. Like we're looking at cancer cells under the microscope, trying to figure out what's killing the patient and saying, well, because this is hitting the endorphin gland, I forget what it's called, it's making the patient feel good while it's killing him. This is the clinical description of the pathology of a cancer. This isn't, anything good, but this is how it's working. So the dollar, is very strong, probably going to get stronger because I think the supply chain problems will get resolved. Shipping and logistics will return to some semblance of functioning normally. And when they do, I think we're going to find there's a huge inventory glut, and then there will be a huge drop in prices of everything.
And so then we're going to, instead of inflation, we're going to get disinflation, and then people will just turn around and the party starts all over again, doesn't it, Keith?
And the party starts all over again, and the interest rate goes lower, which means the prices of assets go higher. Property market in Australia can go even higher than it already has. All these perversities, occur. And then meanwhile, what are we doing? We're marginalizing people. Every time the interest rate goes down, that's an incentive for every productive company to borrow money to replace labor with capital, right? So we're liquidating people at the margin through this. We are rewarding, and Keynes talks about this,
right?
That by monetary debauchery, it generally impoverishes everybody, but it arbitrarily, capriciously enriches a few, and even their fellow bourgeois resent them. So the people that get the timing right and buy Bitcoin when it's $4,000 and ride it up to 60, some of these people now have huge fortunes. They're Bitcoin billionaires running around, and some of them are, let's just say, not necessarily making any friends and not becoming very popular with their attitudes. All of this and properties in Sydney in particular, but in a lot of other stock market in the US being another place, fortunes are seemingly being generated by this perverse process, and it's breeding social unrest, it's breeding resentment, it's creating an artificial.
because you've got this widening gap between the haves and the have-nots, and there's
Yeah.
nothing in between. And so you've got those that have got everything. I mean, I was just looking the other day at the, you use the word perverse, the craziness of the homeless in Skid Row in Los Angeles. And this is, we live in a modern society with more and more people that can't afford to live in a house.
That's right. That's right. And this just, gets worse and worse. Now, one of the exquisite, and that's the only word I can think of for this irony, this whole thing, is that the defenders of free markets, the defenders, would-be defenders of capitalism, will defend it and say, there's nothing wrong with, inequality. There's nothing wrong with, the rich get richer. And in a free market, that's true. But we don't have a free market. We have this perverse system that is unjustly impoverishing people that are working for wages, especially low-skilled people.
Yeah.
And at the same time, is creating apparent unlimited riches. Now, that's called the wealth effect by economists. And on a certain level, everybody understands that the central banks can't print real wealth. They get that. But when people see the prices of the assets they own going up, they feel richer.
Correct.
It's not actually greater riches, they just feel richer. And what they're seeing is boosted prices because people are forking over greater and greater amounts of capital to sellers of assets. So it's the best time to be a seller when the prices are like this. But the seller is getting as his profit someone else's capital. So it's a process of conversion of capital to income, one person's capital to another person's income to be consumed. So it's a giant prodigal system where nobody wants to be the prodigal son squandering their own capital, their own inheritance, but everyone is squandering someone else's capital via the miracle of ever rising, endlessly rising asset price markets.
All right, well, Keith, I love your brain. I love the way it works, but we're running out of time. What I want to know is, my subscribers want to know is, this is all fascinating. It's all really interesting. What do I do? What do I do?
So I'm going to make the pitch for monetary metals at two levels, both to the self-interest of everybody watching this. It's better to get paid interest on your gold in gold, which is what we offer, than either not have gold and just sit there watching the system fail, or to pay to store your gold in a vault somewhere. And if you're paying, 0.75%, 75 basis points, and the interest rate that we're offering is 2 or 2.5%, the difference between the two is, 2 3/4 to, 3 1/4, 3.5% to your gain by opening a monetary metals account. But the broader appeal that I'm going to make is to trying to fix the system. The system is perverse because the base of it is an irredeemable currency, which gives them unlimited license to abuse. And now we're finally seeing just how much they can abuse it. And I saw an interest, somebody else posted on Twitter, and I think I hit like, I think I shared it, and basically said, everybody sees the problems in the system. No one's trying to fix it. They're just trying to make enough money, trying to speculate to make enough money so that the problems won't impact themselves personally. Monetary Metals is a different kind of company. We're actually trying to fix the problem by returning to the use of gold to finance production. And if we can be successful doing that, then production with financing gold, which, as I was saying a moment ago, everyone is dumping their products on the dollar bid. And so the dollar has this perverse support. If people are financing production in gold, then they're looking for gold as revenues, not as dollars revenues. That will be the thing that begins to help the world transition to the circulation of gold. Interest is the only force that will pull gold out of private hoards and into circulation. You can't pass a law to do it. You can send cops or military guys door to door with machine guns. You get some gold. I mean, some people just can't hide it for whatever reason, or they're too scared. For the most part, the gold goes underground.
Yeah.
They just hide it deeper. The only thing that will pull gold out into circulation is interest, and that's what we're doing. So,
and that's what monetary metals are doing. It's, what did you say before? I think you said this is a $12 trillion financial asset that's currently sitting in the gutter, and if we pull it out and we allow people to earn interest on the gold, then you start to get that velocity of the gold coming through the system, which changes the whole ball game.
changes the world. That's what we're trying to do. So become a monetary metals customer, not only for your self-interest, to be able to get interest in real money that can't be inflated or debased, but also to help the world get to a more rational, monetary system, which is the gold standard.
Which I think is also potentially a more honest system. Keith Weiner, CEO and founder of the Gold Standard Institute of USA, and also CEO of Monetary Metals. Thanks for joining me on the Gold News channel. We're going to have to get you back in the new year. That was so interesting. Really appreciate your time.
Thanks, Kerry.